Welcome to today's explainer. Look, if you're an e-commerce buyer or a brand builder, you already know that overseas sourcing is a high-stakes game. One wrong move, you're looking at agonizing delays or worse, completely blown budgets. So today, we're tackling the foundational decision to prevent those absolute nightmares, choosing between a sourcing agent and a trading company. We're going to break this whole thing down so you can build a procurement strategy that actually works for your business. Let's get into it.
So, right off the bat, when you set out to source products from China, what's your primary goal here? Are you prioritizing convenience, like looking for a smooth, totally hands-off transaction? Or do you desperately need supply chain flexibility to dig in and pivot when things inevitably go wrong? Okay, let's dive into this, because your answer to this core conflict is literally going to determine exactly which procurement path you should take. Section 1. Meet the contenders. Let's define these two models.
Contender number one is the sourcing agent. You can think of them as your own personal talent scout right there on the ground in China. Their whole job is to help you find, evaluate, and manage suppliers. Now, the absolute key advantage here is flexibility. Say a factory suddenly doubles their price, or maybe they don't have the capacity you need, or they send you a just completely terrible quality sample. Well, your agent can seamlessly pivot. They'll just go out and scour the market for another manufacturer that actually meets your strict criteria. Then we have contender number two, the trading company. Now, unlike an agent who partners with you to find a factory, a trading company is a commercial seller in its own right. They source products from various manufacturers and then resell those products directly to you. So you aren't talking to the factory at all. The trading company is the actual seller you buy from. They conveniently manage all those hidden factories behind the scenes. For you, this means you just have a single point of contact, making the whole purchasing process incredibly simple. And this right here brilliantly illustrates the core structural difference you have got to understand before you wire a single dollar. A sourcing agent is basically on your team. They represent and support the buyer, which is you. A trading company, on the other hand, is on their own team, acting as a commercial seller whose job is selling to you. Neither model is inherently better or worse, but firmly grasping this fundamental dynamic, that changes how you approach every single deal. Moving on to Section 2, who controls the relationship? Let's walk through this table, because you'll notice a stark difference in control dynamics. When it comes to supplier selection, an agent searches and compares multiple factories for you, giving you actual choices. A trading company? They just use their existing supplier network. Now, think about visibility. An agent gives you a much greater line of sight into who is actually making your product. With a trading company, your visibility into that hidden factory is usually pretty limited. And financially speaking, an agent's earnings, like a service fee or commission, are entirely transparent. Meanwhile, a trading company just bakes their profit margin invisibly right into your product price. For long-term sourcing, knowing a factory's true capabilities, their lead times, and their certifications is often way more crucial than just snagging a fast first unit quote. Section 3, the true cost of sourcing. Let's talk about pricing and risk. So the crucial point is this, and it's a rule to live by. Don't compare unit price alone. I know it is incredibly tempting to just look at the bottom line of a quote, but a cheap initial unit price from a factory or a trading company is actually the most expensive option if you end up paying for massive product defects, expensive rework, or major shipping delays later on. You always have to look at the bigger picture. To really compare apples to apples, you have to calculate your total procurement cost. This equation isn't just the base product rate. It includes packaging, inspection, service fees, freight, and that massive invisible cost, quality risk. Now, an agent adds a highly visible service fee, sure, but their expertise often prevents incredibly costly mistakes in that quality risk category. A trading company kind of hides their service cost by baking the margin directly into the quote. But because they buy in massive volumes, they might actually offer fantastic prices on standardized items they buy all the time. The takeaway? You just have to calculate the total cost to know what's really going to hit your bottom line. Section 4. Contracts and quality control. Before you pay a single deposit, you absolutely need answers to this checklist of questions. First, who actually receives the payment? Who issues the commercial invoice? Who is explicitly named in the purchase contract? If goods show up defective or short, whose pocket does the refund come from? And who is arranging the inspections and export docs? With a trading company, this is usually super simple. You buy from them, they issue the invoice. Done. But with an agent, the legal and payment structure can vary wildly. Sometimes you pay the factory directly, sometimes you pay the agent. You have got to nail this framework down immediately to protect your capital. Now, for the million-dollar nightmare question.
What happens if the products fail? Quality control is literally your only safety net in international trade. And surprisingly, you'll find that how failures are managed matters a whole lot more than the specific procurement model you choose. Both can provide quality control, but the process itself is everything. So here is your gold standard 5-step protocol. 1. Thoroughly document all product specs. 2. Use an approved physical sample as your absolute reference. 3. Always carry out an inspection before shipment. 4. Determine exactly who is performing that inspection. And 5. Clearly define the failure protocol, like what actually happens if it fails. Sourcing agents will coordinate these inspections based on your specific criteria, whereas trading companies typically just rely on their own internal processes. Want a pro tip? For high-value orders, hiring an independent third-party auditor is always a smart addition, no matter which sourcing model you're using.
Moving to Section 5, Custom versus Standard Products. Let's contrast two entirely different buyer journeys. The first buyer just wants a standard existing catalog product. They're a retailer wanting simple, reliable delivery and competitive quotes. For them, a trading company is a fantastic fit. But the second buyer, they're developing something completely custom. They require custom materials, private labeling, new injection molds, or highly specific market certifications. This custom buyer desperately needs a sourcing agent. Why? Because they have to compare the actual technical capabilities of multiple factories and vet quality across entirely different manufacturing categories. A trading company's closed network usually just cannot handle that level of bespoke development.
And finally, Section 6, the final verdict.
Let's summarize how all of this builds into a final decision matrix for your business. It really all comes down to matching your specific priorities to the correct model. If you need to compare multiple factories and do custom development, or you need strict supplier verification across multiple categories, giving you greater sourcing flexibility, well, the sourcing agent is your clear winner. But if you just need standardized products, a simple purchasing pipeline, the convenience of one commercial seller, and easy repeat orders, then the trading company is for sure your best bet. If you take away only one single thing from this explainer today, let it be this core thesis. Trading companies offer convenience, while sourcing agents offer supply chain flexibility and ongoing support. There really is no one-size-fits-all answer here. It's all about finding the right fit for your specific product and business model. I want to leave you with a rather provocative question to think about. Before you place your very next order, do you know exactly who you are doing business with? Really think about it. Stop obsessing over just getting the cheapest initial quote. Figure out who actually selects the supplier. Find out who holds the leverage when the doors are closed and who truly handles the quality control. Once you figure that out, you won't just be buying products. You'll be building a truly resilient brand. Thanks for joining me for this explainer, and happy sourcing.